Do you know the variables that will have the biggest impact on our industry? Stay tuned. Welcome to NoteSchool TV, where we go live every Wednesday at 11:05 Central Time. Thanks for joining us today. We have our monthly industry update, so we'll be getting into that in just a minute. But we look forward to seeing you every week, like we always do on NoteSchool TV. And if you will, go ahead and like NoteSchool TV, and remember to hit that subscribe button, and then make sure to also hit that bell notification so that you will get advance notice of when we go live every Wednesday at 11:05 Central Time. Also, if you would like more information on NoteSchool and what we do at NoteSchool, just simply go to NoteSchool TV or noteschool.com/TV, and you'll see us live every week. So, with that, we're going to jump right into it, and I am going to bring on our Chief Visionary Officer, founder, Mr. Eddie Speed.
Hello there, Joe Varnadore.
Well, hello there, Mr. Eddie Speed. How are you today?
I'm great. How about you?
I am wonderful. I'm looking forward to, our appreciation event in 2 weeks from today. And I'm excited about what we're doing today, and that's our industry update.
We have a lot of information to go over today, guys. I'm really excited. Mr. Varnadore has done an excellent job of really helping put this together today. So, Joe, I'm gonna sort of be the student today, and you're going to be the teacher, because you actually know this information better than me, because I have been preparing for NoteExpo, and I'm going to use some of this stuff at NoteExpo, but a lot of stuff in the news. Joe, let's talk about Fannie Mae selling non-performing notes.
Well, and Eddie, this is one of those variables that we talk about all the time, and we've been talking about for quite a while now. And actually, back in May of 2021 was the first offering of non-performing loans for this year, and now we have two in the same month. So Fannie Mae just named the latest winner of their non-performing loan sales. And Eddie, there was 11,100 non-performing loans totaling $1.68 billion in unpaid principal balance. Wow.
Yeah, and Joe, I think towards the end of this, we're going to find out that there are well over 2 million delinquent notes. This is only 11,000.
That's right.
This is only 11,000, Joe.
Only 11,000. That's right. So, and if you'll look here, Eddie, this shows the buyers of those. There was 4 different pools, tranches, is the big word for that, right?
Yeah.
So we had Barclays, Credit Suisse. They each bought a piece of those. And then Pretium is they're a big hedge fund that, invest in real estate and notes. And they bought the lion's share of these loans, Eddie. They've got a fund of about $25 billion under management.
One of the things that caught my eye on this sheet, Joe, you might take your pencil and circle the column that says cover bid share of unpaid balance. UPB means unpaid balance.
That's right.
Okay. So circle that whole column down there, Joe. And I'm looking at, they paid over 100 cents on the dollar.
That's right. They paid 103% of the UPB, the unpaid principal balance, which was this number, Eddie, $350 million.
But here's the catch, folks.
Yep.
What they didn't tell us was what was the legal balance.
Right.
So that means all of the accruals, the accrued interest, accrued fees, all of those things. And these loans that are seriously delinquent, Joe, it is not uncommon that the legal balance could be 20 or even 30% more than the unpaid balance.
Absolutely. Absolutely.
So they did buy them at a discount, didn't they?
They did buy them at a discount. And you look at that, Eddie, this column here, which is the BPO, broker price opinion, based on the loan to value ratio. And these are what, based on the loan to value.
Yeah.
Well, Credit Suisse, they paid up for those loans, didn't they?
They did. Most of them are in the 50s, but they paid up, and I'm sure there were some unique circumstances to that. And Joe, this wasn't the only trade that happened.
It absolutely was not. So Freddie announced this trade back last month, and it has now closed. $1.3 billion NPL sale. And when we look at this, there are the winning bidders on those three pools as well.
Yeah.
Yep. And Eddie, one of the things that I wanted to point out here as well. So this is the average month's delinquent.
Isn't that something? Joe, these are called legacy loans.
Right.
Because they were loans that were delinquent before the virus.
That's right.
Right. They were delinquent. And there's over 500,000 loans that were delinquent before the virus started. So understand, these are the first loans that are now getting sold in the NPL market. Joe, let's just say this is the first of the glass of water coming over the waterfall.
And, one of the things that I was, when I was doing some research on this, is actually two of these pools, and I believe it was this one and this one, were bought by a firm that is a minority women-owned firm as well, in those community loans where they encourage, for minorities and women to buy these. Yeah.
I'll be darned.
Yep, for sure.
A lot of data, Joe. Let's
a lot of data, and guys, this just crystallizes, what we've been telling you, and what a lot of these buyers in these pools will do. Eddie, they will buy the whole thing, right? We talk about buying by the case and then selling by the bottle, and so they'll keep what they want in the areas they want. Then they'll sell off the rest, and then funds like ours end up with some of these loans also.
Joe, I'll bet you there are loans in these trades that very likely could end up on Notes Direct, our trade.
Absolutely. 100%. 100%. All right. So let's shift gears here just a little bit. So single family investor activity surges in the second quarter. So, Eddie, what I think about this is, rise in the summer months has not been seen in the last 10 years. Summer surge in 2021 making up for irregular patterns. I'm wondering, Eddie, if it's FOMO, right? Fear of missing out, or as Sean McCloskey says, FOL, fear of loss on rentals. All the rental prices are going up, and gosh, so some folks are out there buying houses buying houses to rent at the height of the market. What's going to happen, a little later on down the road with those?
Well, we're not trying to sway your opinion one way or another. We're trying to make you have a fully formed opinion, right? When people tell me trees are going to grow to the sky, theoretically, right? And real estate values are doing this and that, but yet, Joe, they don't mention shadow inventory in the market.
That's right.
I feel like I'm not saying they're emphatically wrong. I'm saying that they're not measuring all the variables. And so we're fully acknowledging this crazy market. There is still a significant shortage of inventory. And so we're just sort of balancing today so that you have all of the information in place. And by the way, when you know the information, Joe, you know the void in the market. So guess what's hot, Joe? Non-performing notes.
That's right. You are right, my friend. So let's talk a minute about Zillow. And I thought this was really interesting. So in the second quarter of this year, Eddie, Zillow ends up buying, 3,800 houses on their iBuy platform, right?
Wow.
So the iBuyers have really, proliferated over the last couple of 3 years with companies like Open Door and Redfin and OfferPad, as well as Zillow buys. But interestingly enough, they still only make up about 1% of the market. But Zillow has bought these homes, but they're tapping the brakes. And because what's happening is their model is to buy the homes from directly from home sellers at some kind of a discount. They do minor repairs and put them back on the market. But you know what's caught them, Eddie? Lack of folks to do the repairs and shortages in materials in the supply chain.
It's flip. There's something to this flipping houses in there, Joe. It's a little harder than people think it is, right?
Well, even Zillow's got plenty of money, but they're like, okay, we're just stopping. We're not buying any more houses this year. We're going to, sell some of the ones, finish them and sell them the ones we have, and we're going to move on for there. But that you're right, Eddie. That's the whole situation. It's labor. The supply chain is getting back in check a lot, but it's the labor market that we're really seeing, just finding workers because, well, they're building new houses and doing all that. So yeah, I thought that was really, really interesting. The company like that would just say, hey, we can't do anything else this year.
Interesting.
Yep.
All right, let's go.
So Sunday launches a platform for purchasing direct distressed property. So Eddie, company this Sunday, it's a new company, and there's their website on the screen there if you want to check them out. But they are a company that they allow folks that have damaged properties, is what they call them. They call them distressed here, but really they call them damaged properties, so they can list those directly on this website for investors to come in and buy them. And it also includes, tons of pictures, 3D views of the houses, a list of things that need to be done. So it's pretty cool.
Joe, what if I told you that the CEO of that company is a former NoteSchool student?
Really?
That's a fact.
Well, I did not know that. Do I know him?
Josh Steck. Great
really?
guy. Smart guy. Super smart cat.
Okay. Yep. I know the name. So just again, just a way to sell more properties out there. Boy, Eddie, technology is an amazing thing, isn't it?
He's a really smart guy. He was also one of the founders originally of Lending Home.
That's right. You're exactly right. Good friend of another friend of ours, right? So, Eddie, let's talk about how landlords really have been impacted by the pandemic. We know that, well, we've talked a lot about this, haven't we?
Well, if you look at the chart on the left, it paints a pretty incredible picture of shortfall in rent, Joe. Mm-hmm. All landlords, not just on houses or, apartments, but all landlords went from 11%, right?
Right.
To 37%.
And those are folks that are collecting less than 90% of their rent, right? So these are the latest stats, right? These are from 2021. So we haven't gotten or from 2020, we haven't got the 2021s yet. But yeah, 37%. And we know as this thing has kind of progressed that those numbers have gotten even higher as well. And Eddie, this is kind of where we play is when we're talking about the small landlord, this 1 to 5 units, right?
Well, think about it, Joe. The small landlord is 72% of the properties in this category. 72% of the 1 to 5 units are owned by a guy that owns 5 houses or less in his individual name. So he's 72% of the market is the small-time landlord. And what we are also led to believe is the small-time landlord's rent collections shortfall is a much bigger number than the professional managers.
That's right.
So it's pretty, and obviously this is why we say that we're so zeroed in on this being a void in the market that we can have a great solution to.
That's right.
Single biggest thing I teach real estate investors today is specifically how to chase landlords and how to position it where they're dying to sell to you.
Right. And if we look at this second piece on here over here, and what this is saying is 10% of the 1 to 5 have collected less than 50% of their, and that's a huge number. We know it's somewhere around $20 billion, right?
Amazing number.
Amazing number. So again, share of landlords reporting changes in management practice, right? So waiving the late fees, forgiving rent, deferring rent, cutting some of their maintenance. So again, it doesn't paint a pretty picture. And this is especially for this 1 to 5 guy. This is huge.
Yeah, big deal.
Yeah.
Because once again, he's not a professional manager. So a little bit different dimension here, Joe, but same thing. You can see, obviously, orange represents 2020.
Right.
And the black or the gray is represented by 2019. So you can see the significant amount of forgiveness in rent, late charges, deferring rent, all the above. And this is what's got us in the position we're in, in knowing that the small-time landlord is so motivated to do something different.
Well, and we know that about it's 60+% of those 1 to 5, the 1 to 5 units manage their own properties, right?
Yeah, so about 3/4.
Right.
About 3/4 of the small-time landlords manage themselves. Okay.
So talking about a shift in the variable, there's another one, right? So Eddie, let's talk a little bit about, Mortgage Monitor from Black Knight. We use this every month, and some very, very telling stats as we continue to move forward and end up with 2021, right?
Yeah, no doubt. Now, everybody remember when we have these reports, they're running behind. They're always running behind, but we monitor this all the time. And so, Joe, let's talk really quickly, if we can, about mortgage delinquency and where we're trending and what the numbers look like.
Right. So we know that 4% is what, and this doesn't include any forbearance loans. This is just delinquencies in loans. So serious delinquencies, they fell 108,000 between July and September. And then, but the delinquencies are still 3 times higher than they were pre-pandemic. And so, Eddie, one of the numbers that stick out at me, right, and we have a chart here in a minute, but I'll go ahead and just kind of mention this, 4%. So, Eddie, at any given time, there's about 53 million single-family mortgages. So that number is, it's north. It's about 2.120 million loans.
And these are loans that are not in forbearance. They're just delinquent.
Just delinquent. Yep. Just delinquent.
Joe, what we have, we have a pin-up inventory of loans that were delinquent before the virus.
Right.
So what we have is now all of a sudden within the next, call it 6 months, Joe, that there's going to be a default scenario that is going to ultimately lead to they must sell or get foreclosed on.
That's it.
Or bring it current. And we know that people that are 30-something months delinquent have a hard time bringing it current.
Well,
and a lot of these people, you say, well, why don't they all go get forbearance? And the truth of the matter is a lot of these loans are in various situations. They don't qualify for forbearance.
That's exactly right. And then we look at the next slide here, and this is really telling here, right? So 2.5 million borrowers rolled from current to 30 days delinquent in the first 8 months of 2021. But this one is really the telling piece here, right? 750,000 borrowers became 90 days past due in August alone.
Joe, I can tell you this from being in this industry for 40 years. The 90-day mark is when it becomes so much money they can't get themselves straightened back up. Right. And that's why in the loan industry, 90, 120 days, it's right in there that people know that loan may not fix.
That's it.
And so that is an incredible number. I can't even imagine. And we're going to monitor this as we always do, but we're going to monitor this. But I can tell you right now, from being in this business a long time, though a lot of those assets will end up in a forced sale or a foreclosure.
And one of the things that we haven't talked about, a lot of these folks do have equity in their property, but still they're going to have to sell. It's the only way they can fix it.
That's it.
That's it.
Hey, Joe.
Yep.
You know what we're going to talk about at NoteExpo?
What are we going to talk about at NoteExpo, sir?
Burnout landlords.
Yeah.
We're going to, and how to monetize it, how to help them, how to help us. One of the biggest market opportunities I've seen in many, many years.
Right.
We're going to talk about delinquent notes. We're going to talk about who can get a mortgage and who can't get a mortgage.
Right.
So guess what? Let's hear a word from our sponsor, NoteExpo.
See you at the next NoteExpo.
See you at the next NoteExpo.
Hi, everybody. I hope to see all of you next year at the NoteExpo.
See you next year.
See you at the next NoteExpo.
See you at the next NoteExpo.
See you at the next NoteExpo.
I had a great time and I will be back next year. See you at the next NoteExpo.
Hey, see you at the next NoteExpo.
See you next year at NoteExpo.
See you at the next NoteExpo.
It's been a fantastic expo. See you next year.
See you at the next NoteExpo. I already bought my tickets. Have you?
We are fired up, aren't we, Joe?
We are fired up. And guys, you know, like they used to say, what was it in the 60s? Be there or be square, right?
We are very excited. We have an impressive audience. We are the first live note trade show, live audience that has been this year, and we will probably be the only one this year. And we're really excited about it. And our lineup is amazing.
Yeah.
All right. So Joe, we've been talking about delinquent notes. We've been talking about burnout landlords. Now let's talk about a little bit about people that did a contract with their mortgage lender.
Right.
Where they legally agreed not to pay.
Right. So we look at this forbearance activity. So forbearance plans fell to 1.6 million for the first time since the pandemic has begun. So interestingly enough, Eddie, last month, 450,000 plans expired. Another 500,000, and you can see over here on this, you know, kind of the graph over here of how that's working. And then in November, another 137,000 plans are set to expire there. So, you know, if we look at it, Eddie, that number, there's a lot that is expired, but here's what's going to end up at the middle of the day. Right now, we're still at about 1,250,000 for forbearance plans are still kind of in the hopper.
Yeah, this situation, as we said, it's been pent up inventory.
Yes.
And obviously we're looking at this, Joe, because we realize that some people are going to qualify for an extension or a modification.
Right.
But let me just tell you that not everybody that is in forbearance is going to qualify for a modification. And so once again, that's going to be more loans that are going to be either they're going to have to sell or they're going to get headed to foreclosure. That's it.
And Eddie, I thought this was an interesting piece here as far as what's going on. Even with these expiring, new forbearance plans were up more than 25% since mid-August. So this was from the middle of August through the end of September. Again, the numbers for October hasn't came out yet. But look, most of these were driven by FHA and VA loans. Right. So talk a little bit about that as far as what that means as far as the FHA and VA loans.
Well, FHA is far and away the most delinquent of the GSE loans, right? Government GSE means government sponsored enterprises, right? So that's Fannie Mae, Freddie Mac, FHA, VA, and also farmers' home loans, right?
Right.
And but the sore thumb sticking out from the very get-go has been FHA,
right?
And obviously they have lower underwriting standards. And but this is a shocking number, Joe, because logic tells me that we should not see an increase in August.
We should not.
Logic tells me, well, this may be a sign of things to come.
That's it. And then finally on forbearance here. So all in, more than 250,000 plans will expire in 2021. But you remember, we were up at the height. What was it? About
I believe that's 850,000.
850,000. Yeah. Right. I missed a zero there, I believe. So yeah, more to come on this. And again, as you said, the FHA, the VA, those loans or Ginnie Mae loans, and again, they were the qualification was less for that, and the down payments would have been very small as well, with the average conventional loan being almost 20% down.
So we've been talking about the wall is getting closer, right? We've been saying this for months and months and months. As we close out 2021, we're looking at just under 1 million loans, 850,000. The forbearance plan is up, no extensions, nothing, and so this is definitely going to be a market factor. And Joe, we believe that at least in our industry, we talk about this literally at least once a month because we have this, and we don't hear other people talking about it. And we believe that, first of all, this shows us where there are opportunities, and it shows us a dimension of the market that allows us to make a clear decision about where we think the market's going.
Right.
Because they're not putting this on the nightly news, are they, Joe?
Well, no, what they're saying on the nightly news is that real estate is on fire, and there's that two sides of the market, right? There's this, and then there's really what's happening kind of in the underbelly of this. So yeah, this is interesting as it continues to play out.
All right, let's keep looking here. This is this shows you the hot markets.
Right.
Austin and Phoenix. Whoa. Crazy, huh?
45 and 33.
Yeah.
And even the number 50 is up 10.8, and that's in Pittsburgh, right? So, yeah.
That's it.
Yeah. All right. So, Eddie, we're going to wrap this up with this. And we were talking about number of loans in that are right now. This is as of 8/31, again, which is the latest the data that we have. So we're at about 2.264 million there. Plus, we're at about another 1.25 million for 1,250,000 in still in forbearance, and it remains there. So we're still looking at about 3.5 million loans that are in trouble at this point.
So, Joe, let's do a comparison. There were 500,000 loans that were delinquent before the virus.
Right.
Okay. Very low number. 1% essentially, right?
Right.
Now all of a sudden we're at call it 3.5 million loans. That's not the exact number, but it's close enough.
Yep.
That is a comparison to that's where we are now compared to where we were pre-pandemic. And it shows you that there is a lot of unanswered questions about people that are, and it's like when we're talking about this in April, we say, well, it's coming. Joe, it's here.
That's it.
These loans are coming due, and lenders are taking action, and lenders are selling these loans. And I would say that this is in my career of 40 years in this business, Joe, I don't believe I've ever seen such a unique opportunity in non-performing notes as I see right now. You say, well, what about in the RTC days? Yep, I was there. What about in 2008 and after that? Yep, I was there. But in those markets, Joe, we had a super declining real estate market. Now we have a hot real estate market with delinquent notes.
And Eddie, the great thing is, and you said this, I've heard you say it 10 times, and it is so much easier to work with these loans, these non-performing loans today than the ones that were back after the Great Recession, right?
Well, you go back and you look at those grids of those Fannie Mae loans that are trading. They're investing almost the full amount owed, not the legal balance, but the legal balance. Now the legal balance is on top of that, right, Joe? They're investing in those loans, and they're still at like 65% of what the property is worth. Well, those are loans that from experience, if your attorney is foreclosing for you at the courthouse steps because you're the bank, you're the lender.
Right.
If he's foreclosing for you, you're going to have a third party get paid off.
Yeah.
And so you're not going to have to own these loans as long, and you're not going to have to do near so many tasks to be able to do this. And we're going to talk a lot about this at NoteExpo. We're going to have people that are right at the heart of these trades, and you're going to get to hear from them and what they're experiencing, and we're going to get cycle times. So that's really going to be exciting. Now, Joe, we got 2 more slides.
We do, and talk about this one, sir.
You know, Joe, when the president was elected, he pretty much did some significant things related to the oil industry, and particularly shut down the pipeline production and did some other things. And, the world of supply and demand is we are not producing our own oil to where we were.
Right.
And so now we're having to buy oil, and our buddies across the pond are wanting a little more money for it.
Well, that's the whole supply.
We just grabbed this slide a day or so ago, but we are, just call it, under $83 a barrel. And look at that trend there, Joe. Just look at where it's trending. Let me just tell you, this is something to pay attention to. And Joe, historically, as you well know, this is a big driver in interest rates.
Absolutely.
We've been relying on a residential real estate market that is heavily driven by below market rates.
That's it.
And so this is going to be something to pay attention to and watch for. And Joe, the next thing is something I think we want to pay attention to also.
Right.
Talk about this.
So, yeah. And I read this and I go, what? China reported hypersonic missile test, an important surprise for the U.S. So I guess they snuck one by on us, right?
Well, they did. That this hypersonic apparently goes 5 times faster than sound.
Yeah, a little over 5,000 miles an hour. That's pretty fast, dude.
That's crazy, huh?
That's covering some ground.
Now, Joe, that thing is supposed to be able to deliver a nuclear warhead, and but they said, don't worry, they missed the target. They missed it like 24 miles. Well, Joe, I don't know which big metropolitan area you could say, but if it missed by 24 miles, it's still close enough.
Still close enough, right?
I hope we are paying attention to this, Joe.
I do too.
What concerns me is one of the things is that it's one of the things that said in this article is we're not prepared for this.
No.
So not to scare you, but to be informed. This is
live in interesting times.
So China is home sales has got a little issue here, Joe.
Yeah, there's a big company there that's got about $300 billion in debt they can't pay called Evergrande. And yeah, there's some big challenges. 19.7% down in year over year in August, 16.9 in September. Eddie, I was looking at some stuff on this, and there are entire small cities of properties and high rises that have been built that just nobody lives there.
Vacant cities.
So,
all right, Joe, let's talk about this. Bring us home here. Talk about our sponsor of NoteSchool and our one-day class.
Yeah. So guys, thanks so much for joining us today. This is, as we said, the variables, and we are going to stay up to speed, right? Get the up to speed with Eddie's speed, right? As we continue to move forward. So again, if you want more information about NoteSchool and about what we do, if you've got a question, whatever that looks like, we do this for you guys, and we depend on you, and you depend on us, and we want to bring you the best quality content that we can possibly bring you. So again, if you have any questions, or if you would like to go to one of our one-day classes, please make sure and check that out at noteschool.com/TV. Again, noteschool.com/TV. Thank you so much for being with us today. Have a great Halloween, and we'll see you on the other side. Take care.